Well, tēnā koutou katoa, welcome all, kia rana, tātou katoa, and thank you again, as always, for turning up at this fine establishment. So we're here today to talk about the Financial Stability Report, and I'll just make a couple of comments in advance. As always, I'm very pleased to be here with the Deputy Governor, Jeff Bascan, and Head of Financial Stability, and with Chris Bloor, who is the wise man in the room who's been in large part responsible for pulling this document together, along with many other people at the bank, many of whom are with us in the audience this morning. So first up, I just want to say that the risks to New Zealand's financial system have eased over the past 6 months, but the vulnerabilities still remain. In particular, households remain exposed to financial shocks, in large part due to the mortgage debt that they hold. However, pleasingly, both mortgage credit growth and house price inflation have eased to more sustainable rates, and this has reduced the riskiness of new bank lending to housing. In response, we are easing our loan-to-value ratio, the LVR, restrictions on banks' new mortgage lending. If banks' lending standards are maintained, where they have been over recent months, then further easing in the LVR could be possible over the coming next few years. Debt levels do remain high, however, in the agricultural sector, particularly for dairy farms, and that implies ongoing exposure to financial vulnerabilities. Balance sheets do need to be strengthened further, and in particular, given the likely investments needed in the medium term with some of the challenges coming for agriculture in particular, as represented through climate change, investment will be needed. While domestic financial risks have eased, global financial vulnerability has risen. We have significant build-up in debts and asset prices, and the ongoing geopolitical tensions and trade challenges overhang financial markets. This vulnerability is highlighted by the current elevated volatility in equity and debt market pricing at present, and that will be on a watching brief. We are pleased that New Zealand's bank exposures have reduced somewhat to these global risks, and in large part that is because of the smaller or lower reliance we have on foreign funding and short-term debt funding in the banking system. The domestic banking system remains sound at present, and we are using this period of relative calm to assess whether the banking system has sufficient capital to weather future extreme shocks. Our view at present, which we'll be making public mid-December for final consultation, is that higher capital requirements are necessary across the banking system so that they are sufficiently resilient to extreme shocks. And we expect to have a full consultation over coming months to finalise the capital requirements for the banking system. The banking system remains profitable, which is a good thing. We like profitable banks and we like well-capitalised banks. While positive overall, some of the bank's profitability has been driven through the low costs and we believe partly achieved through some underinvestment in core infrastructure and risk management frameworks. And this is what we talked about jointly with the FMA from some of our findings through the Bank Conduct and Culture Review recently discussed. As we've made public, we will be reviewing again banks' responses to our Conduct and Culture Review in March 2019 and seeing what individual action, if any, we need to take from there. As is well known, CBL Insurance was placed into full liquidation by the High Court on the 12th of November. Aside from CBL, the insurance sector as a whole is meeting its minimum capital requirements. However, the capital strength has declined, and a number of insurance companies are operating with what we would call a small buffer relative to the minimum capital or solvency requirements. The insurance industry must ensure it has sufficient capital to remain solvent in all business conditions. And we are currently undertaking, again with FMA, our review of the insurance industry's conduct and culture review, and I believe that will help illuminate issues that we need to talk with insurance companies around adequate solvency and risk management. That's the formal introduction, so we are open for questions. Pleased to see people using microphones.
Absolutely, we were warned. Just on LVRs, they were only meant to be a temporary measure, so I was just wondering if you could go into a little bit more detail about when they're going to come off completely.
I can't recall if we've ever said they're only meant to be a temporary measure. They are an instrument that is used for cyclical issues. By cyclical issues, it means that the level of the LVRs will change as the cycle evolves. Where we are at present is we are saying, will an endpoint at a neutral period of a cycle be zero for a setting for LVRs or something positive? And we haven't landed on that yet.
So what conditions from the Reserve Bank's perspective would you have to see for it to be eased further or come off completely?
That bank lending behaviours remain sound and responsible, and that the elevated risks around household debt is reduced.
So how far away are we from that now?
Some way away.
Some way away? Are we talking a couple more years?
I can't elaborate any further. Some way away. We will be, I would say, over the next 6 to 12 months, providing at best as we can a flight path and a timeline around how we think about the LVRs going forward.
When you mentioned that household debt factors into your thinking with easing LVRs, do house prices more generally, aside from the debt issue, factor into your thinking, or is that?
Very much so. I mean, what we're talking about is our purchase, our leverage is over bank lending standards. Where they then lend to is up to the banks, and obviously the growth that we've seen in bank lending has been to the housing sector, has been to mortgage debt, and in part that is underlying a lot of the house price inflation. A big concern that we have, of course, is during following very rapid elevated price increases in any asset, there's a likely expectation you can see the reverse happening, and that is what leads to economic loss and distress throughout. So we are pleased to see that house price inflation in aggregate has eased more towards something low and at least consistent with income growth, and so that is part of the confidence that that has given us.
How do you expect the loosening of LVRs to affect the mix of bank lending to investors versus first home buyers and other owner-occupier buyers?
We've been very pleased, and I'll let Jeff or Chris talk about it, but I'd have to say that first home buyers are getting very good access to the higher LVR loans, meaning that banks are thinking hard about the allocation of loans, and first home buyers obviously are very often the ones with the highest mortgage requirements. So they're getting a very good proportion of it. We expect in aggregate that banks will do what they did last time, which is use as much as they can, subject to some buffers they've been putting in for themselves, all of their new lending capacity, if they're able to get it out the door. Around the investor side, I mean, restrictions, they have come off a little bit, but they remain tight. Jeff or Chris?
Chris, do you want to?
Yeah, so at the moment, around about 2/3 of high LVR lending is going to first home buyers, and we'd probably expect that will continue as we ease the policy. So at the moment, around about 1/3 of first home buyers are getting high LVR mortgages, and we think that could probably rise to maybe 45% or so with this easing in policy. So there is a significant share of high LVR lending going to that first home buyer segment.
Just with the investors, do you expect the portion of bank lending going to investors to increase?
Yes, given just based on past behaviour, they've been given a slight bit more room, and banks tend to take that slack up. And what we'll be watching is to make sure that it's being done in a responsible manner. I will say our single biggest difficulty, which is what we've talked about in the past with these LVRs, is we can look at history. We can look at how banks are using those limits. It really comes down to banks' responsibility. Are they going to be responsibly lending and avoiding the types of issues that we're talking about, or are we going to have to retain and or even increase again or reverse the LVRs? Because, in a sense, these are speed limits, and we want people to stay within the speed limits without us having to change the signs each week.
Right,
Can
so
I,
just-
can I ask you to give further details about exposure of the agricultural sector at present? Can you give me more flesh on those bones?
Yes, I mean, well, debt remains high, but it is actually concentrated. So it's an interesting one where, again, dairy industry for a start has the highest total debt, which is no surprise. It's the newest game in town. It's the highest capital intensity form of farming, and the corporatisation, or I'd say aggregation, has led to a lot of debt growth. But sitting within the aggregate number is a very high concentration of debt within a few areas, a few pockets of dairy farms. And that's in part why you see that even though in aggregate, things are starting to look a bit better and people are paying back, non-performing loans in some of the bank's books have stayed the same because they are the same loans and they are big. I think, Jeff, what was the stat?
About just under 20% of dairy debts of farmers hold over about a third of the debt. So you're talking, 1/5 holding a third. And that concentration is a hardcore element to that, which banks are trying to manage, working with the farmers to try and get repayment, and fewer of the loans are interest only. More of them are going to a debt amortisation schedule. So we're making progress, but it's slow, and it's definitely on our watch that they need to continue, as the Governor said, repair those balance sheets.
Is there any special region that you're talking about, and is there any risk of these farms going under?
Well, they're vulnerable to dairy prices, obviously, and we've had a few months in a row of declining dairy prices. Are still at a level that we believe that the sector is in positive cash flow. But if they kept going, or if you got some of the tail risks we see in the international environment, then it would be more fragile. So it's a classic thing. While you're making some positive cash flow, use it to repay the debt and try and get yourself into a stronger position.
Okay, one final thing. Is there a particular region that's affected?
Regionally, it's generally where you've seen both the aggregation of farms, the more corporatisation farms, and also more recent conversions. And so some of that points towards the South Island in those areas. I would point to our dashboard, paid advertisement coming in, or unpaid advertisement, our Reserve Bank financial dashboard, which allows you to dig into these statistics quite real time around total lending, which banks, concentration. It won't give you regions or names, I'm sorry, you'd have to ring the banks themselves, but I don't think they will either.
Can I just return to the investor question? Can you talk us through the rationale of reducing the deposit requirement to 30%? A couple of economists my colleague has spoken to has been a bit surprised that that's been dropped to 30%.
We've always seen a risk margin that investor loans are riskier than owner-occupier loans. Generally speaking, we've thought that about a 10-point margin in the LVR ratio, if you like, is a better reflection of that relative riskiness. So that takes us to that sort of longer term relativity that we're comfortable with. Probably the slight easing of both owner-occupier and investors we see is about the same in terms of both them. A cautious easing, it's still quite restrictive. We're still leaning against really high-risk lending. 30% deposit requirement for investors is still biting. It's just biting a little less, I guess, is what we're saying.
Just back to the LVRs, do you have any concerns that the changes that you've outlined today will do anything to overstimulate the housing market in Auckland?
Of course we do, which is what we talk about. If you read the opening paragraph of our presentation, we say that this is eased on the basis that banks will continue to behave responsibly in this space, and if they don't, then the LVRs go back up. So that is a concern. Likewise, we have concerns that, this is a cyclical one. We said we would behave consistent with the behaviours we're seeing, and that's exactly what we're doing.
And do you have any concerns about Auckland following Sydney's big drop in house prices?
We do monetary policy for New Zealand, so
So no comments about Sydney?
no.
Maybe just to add to the Governor's big picture positioning, which is absolutely right. We're not targeting house prices in a region or anything like that. But there are some special factors in Australia where apartment building was very, very strong. So the supply conditions were certainly somewhat different. And we think probably that their credit standards have tightened very significantly in the light of the Australian Royal Commission. We've had some of that, which gives us confidence in our prudence of our banks, but we don't think we've got the same severe credit pressures that are binding on their markets at the moment.
And I would refer people back to the monetary policy statement. These two, although we do the reports independently, they are interlinked, and that gives you a good thorough view around how we see the relative pressures up and down on the housing market and house prices.
And just back to some of the opening comments that you made, you were talking about some of the banks, you think that they require more capital. I was just wondering if you could elaborate on that and how much more capital you think that they need.
I can't, north of where we are, I can't talk about that number because we're finalising that and we have some bits and pieces to complete, but come mid-December that will be made public. What we've been doing is a thorough review on a risk basis for New Zealand around what is the minimum and then what are buffers that make it better for the risk that New Zealand banks face. And so a very specific challenge there. Now, there is no science to this, so we've been calibrating it to where we have sufficient capital, where the banking system is both sound through many economic conditions as well as efficient. So we're finding that optimal, that sweet spot, I would say, and the sweet spot is north of where bank capital has currently been.
Is this something that New Zealanders should be concerned about, that banks have essentially been undercapitalised?
I think all countries should be, always. I mean, bank capital ratios have declined continuously in the last 30 plus years, even though bank crises have been as frequent as they ever have. Bank capital is the number one safety valve for citizens of a country because that allows us to absorb losses before it becomes taxpayers' losses and or all future generations' losses. People forget about losses are not just borne by the current taxpayer, but by lost output now and for many years to come. And this is the framework that we're bringing together to talk about bank capital. In addition, it's much easier if banks have a decent buffer of capital that we can observe and they know what kind of reaction function they're going to get from us, the regulators, as capital fluctuates. So we can calibrate our deliberations and our interventions based on where they are relative to something that is minimum, because once they go through a minimum, it's all getting a little bit late, and that just ends up bringing the nuclear options out rather than the intervention options. So this is all part about us heading towards being, the world's best regulated relationship with well understood behaviours coming from the bank, from the Reserve Bank, as capital ratios change.
In light of those comments, do you have a message for banks today?
Yes, I think I've just given it. We will be expecting more capital, and they know because we've already gone through consultation well and good quality capital.
The easing of the LVR restrictions, I gathered from reading the report that the banks have tightened their own lending standards, so effectively they've put in place their own disciplines. Is that the reason why you're now okay with further easings of those restrictions?
It's we're okay with further lending restrictions because we've seen credit growth slow. And credit growth slow to something where we can say is more understandable and safe for new mortgage lending. The cause and effect is always the tough one. Has that slowed because we deliberately put brakes on, or have banks both used the brakes and re-engaged their own brains around responsible lending? That is always to be tested. At the moment, I don't think we're going to learn anything even from this exercise. It's going to be interesting because If banks take up the full slack of that, well, does that tell us that they themselves are more responsible, or they're just adjusting to the fastest speed limit? So we have to keep looking at the total aggregate and how it suits us for the system as a whole around the lending.
And just on the assumption that investors are riskier than owner-occupiers, that is an assumption, isn't it? Are you planning any work to establish whether that's actually true?
I think it's more of an effect than an assumption. I mean, riskiness, depending on how you define it, they have much higher leverage, which means it's much easier to kick the stool out from underneath them. When you have got a loan on top of a loan on top of a loan, well then, you have to remove one of those. So it's a fact, not an assumption. Is anybody?
Correct, and we did put analysis supporting that into the regulatory impact statement when we were introducing
The
the
data
LVR.
shows that most investors have very low relative LVRs. There's only
Sorry, I don't understand the question.
There's only a few investors that are highly geared. Most investors tend to be relatively lowly geared.
There's certainly a lot of evidence, including from the housing crises, particularly in Ireland and other places, that investors do default much more when downturns occur, and that underpinned our analysis and substantiates a view that they are more risky.
And it's not just Ireland as well. We do have some evidence from New Zealand that investor loans have defaulted a little bit more often than owner-occupier loans. And also in Australia, the same case has been seen, that investor loans have defaulted more frequently in the last 20 years.
Just on the easier LVR rules, the slight easing in January, has that had any impact on regional house prices, which seem to surge quite a lot through this year? Have you investigated whether it had any impact there?
Look, we expect that, or we know that banks have used most of the buffer, increased buffer that we provided in January this year. So high LVR lending has expanded by roughly 4 or 5 points. So it's definitely in one factor it's contributed to supporting the credit growth that we've got. But as the Governor's outlined, overall credit growth has been pretty modest, and there are those other factors of lending standards, the debt servicing requirements. I mean, banks got a number of factors it takes into account. LVRs is one, the other is the serviceability of loans, and they have been themselves setting slightly higher standards on that. So these factors are all going on there. How it spills out regionally in part depends upon population, local demand, how quickly those areas supply, can build houses and so forth. So, we always said it was hard to run a regional policy, and we remain of that view.
But do you think that house prices would have risen as much as they have regionally if you hadn't eased those rules at the beginning of this year?
It's been a factor in the demand, so it's probably had some impact on price. We sort of anticipate that. We expect that this will have some impact as well, but not at a level that causes us concern. Inevitably, it's going to provide a little boost to housing demand. We would expect that.
So, Governor, why ease the restrictions when the household debt to disposable income hasn't actually dropped all that much? So households don't seem to be that much safer. It's just the banks who have, I suppose, less danger because the rise in house prices has increased the equity against their debt.
Again, I wish we had the tools that you were looking for, which appear to be highly specific, regional and highly individual and timely. We don't. What we have are tools for the system as a whole, for the country as a whole, for the monetary region that we produce New Zealand dollars for. So with that said, what we're looking at is what I would call an optimal deleveraging. Will we see an optimal deleveraging? I don't know. What is an optimal deleveraging? One where house price growth remains pretty low and flat, while income growth increases and these price to income ratios we see start to go back down towards more normal average levels where you don't have the elevated risks that we're talking about. What have we seen to date over the last 18 months? Exactly that. What are we forecasting at the moment? Something that looks like that. How reliable are our forecasts? To be determined. And, you know, that is why we will continue to watch, worry and wait. The LVR, by the way, is just one, you know, tool. And it's a cyclical tool around a specific purpose, which is the sharp edges around new lending and the risks that can bring in. There are many other tools which are far more important if and when particular crises happen. We've talked about the capital ratios. We'll talk about particular impositions. We'll talk about the official cash rate. You know, so it's you know, it's not as simple as having this laser-like tool.
You mentioned climate change in a box in the report. Do you think banks and insurers and homeowners are sufficiently prepared, either in terms of capital or their expectations about prices, for climate change impacts? I see a report today that some parts of Petone might be uninsurable.
I would just bluntly say no, because it's better to assume no and to get ourselves sorted. And, you know, I say this, by the way, globally, not just domestically for New Zealand. I mean, you know, the relative price pressures that you might see in insurance are starting to shift towards, you know, we've now got, they're now talking more specific risk-based, i.e. if you live in an earthquake zone, you might have to pay more rather than absorbing it in general insurance. Are we seeing that across insurance for climate-related challenges sufficiently and in a way in which we can understand that it's not just a price-grabbing opportunity or revenue-grabbing, that it is actually relatively risk-weighted and averaged through time? What we are seeing is financial institutions talk about what they're doing around their own personal carbon footprint, but not necessarily about how they are then putting that into their lending and borrowing thoughts. And this is where, you know, we have to move rapidly. There's going to be regulatory impost, there's relative consumer price impost, and part of that will come through financial pricing, and it has to hurry up.
Do you think that banks and insurers should hold more capital over the next 5 to 10 years because of these risks?
That is one risk that we think why they should be holding more capital, but I'd also be saying, irrelevant of the level of capital, the allocation of capital needs to be thought about quite hard as well, about whether they are properly allocating capital towards sectors or particular places that need more because of specific risks, and likewise if you are taking away the averaging, then well, where is it being reduced?
In terms of the way that the insurance industry is changing to adapt to climate change, as you've mentioned, it's changing its pricing models. What are your thoughts on other ways that it can change the way it provides insurance? For example, providing contracts that aren't a year long but might be, say, 10 years long to better match up to mortgage terms, and whether changes like that could be made to sort of mitigate some of those risks?
Yes, I think, and I'll let them talk about it, I would say our insurance industry in general is vanilla, and I would say lacking penetration into our everyday lives. New Zealand is very underinsured relative to other OECD countries and relative to some of the risks that we pay. And that's through a whole host of different particular reasons. You know, we've got EQC, we've got ACC, but there are other specific reasons. So I really do believe that globally the insurance industries need to engage better. The reinsurance industries need to be thinking more long-term, and wider businesses need to think about how they can be providing part of that capital.
Are you keeping an eye on insurers as they reprice and move to risk-based pricing, that they aren't, as you're saying, sort of just going for a bit of a money grab and using it as an excuse to up premiums more than perhaps they need to?
Oh, look, it's an industry that's definitely trying to adjust to the information that's arisen from the series of earthquakes we've had. You know, that's affecting repricing. Risks of climate change and storms and everything else. It's an industry that's got quite a lot of challenges to work out how it responds, and I think what the governor's saying is that we've got to get them to lengthen their horizon to look at this, along with the banks. We're going to begin that dialogue more purposefully with them and make sure it's really built into their proper risk management perceptions at board level and are thought about it in a number of ways, not just an immediate pricing response.
Okay, and finally, sorry to jump around, but back to LVRs. Are they here to stay long term?
Yes. Will they always be on? To be determined.
Just to follow on from those questions about insurance, just what is your what is your level of concern about insurance, about the insurance industry at the moment?
I would say it's multifaceted, and come January when we have our report out, we can be more detailed on that. Multifaceted in a couple of senses. One, we talk here about capital buffers and why are they declining at a time when supposedly risks are rising. CBL shows you how the challenges that can happen there. The second one is about coverage. We are quite lowly covered in some areas. The third one is around pricing. We have very high costs in some forms of insurance that we talk about in our document there, fees. Some around behaviours and incentive structures. It's a complex issue where you've got agents working on behalf of agents. Do the insurance companies know how those agents are behaving on their behalf with their products on the way through? And you've got the horizon issue, which I think is really critical. Are they truly thinking long-term horizon? Some of those issues are specific to New Zealand, the coverage, the pricing. Many of them are actually global. And this is why you're seeing the G20, you're seeing, in fact, we are now members of a central bank network focused very specifically on climate change, both for insurance and banking regulatory issues, about how can we be more involved in coercing and or incentivising longer term horizons around these issues.
And just on the global uncertainty side of things, the geopolitical challenges you talk about, what are you watching? What has you a bit concerned at this stage?
I think the simplest way of talking about it for New Zealand is if our monetary conditions suddenly dramatically change based on something that did not originate from New Zealand. And this is what is happening around in some parts of the world at the moment. For example, emerging market countries are finding much higher borrowing costs, tighter financial conditions at the time when they actually want looser conditions, because money is flowing back into the US for some obvious reasons, being higher interest rates in the US as they're starting to tighten, and less obvious reasons, a sense of flight to quality in case something bad happens. And that is probably the number one transmission mechanism for New Zealand. We have a financial shock unrelated to anything happening here. The second parts are the ones we read about more often, which is the direct trade issues and so on and so forth. Personally, I'm less concerned about that. They can be damaging, but they're more slow moving. We can see those happening and businesses will be having to adjust. At the moment, we are one of the least directly affected trading nations to the US-China trade discussions, because a lot of our products are quite frankly quite basic products that aren't going into value-added chains. They're either consumed directly or into domestic construction. It's the financial shocks that can lead to the unanticipated, particularly if you've got high leveraged households and farming sectors.
I just wanted to return to Jason's earlier question about house prices in Sydney. Obviously, it's not just Sydney, but London, other Australian cities and other global cities that have had these out-of-control housing markets for the last 10 years. Now, the reasons why, as you said, they've had large, often state-backed building projects and low interest rates, which have seen house prices grow and now level off and go backwards. But what is the specific difference that makes you think that that won't happen here? Why will they stabilise and not go backwards when it looks like?
Yeah, that's a good question. And I would be saying that there are some common factors and there are individual specific factors. Can I say it won't happen here? No, because some of the common factors are very clear. You've had easy monetary conditions, you've had rapid credit growth into housing mortgages, and you've had elevated prices to earnings. And they are very similar to the New Zealand situation. Now, what are some specific factors that might give us some better cause for comfort? We have had strong net immigration, meaning there's real supply. We've had real demand. We've had real supply constraints around the building going on, and we haven't seen as tighter lending restrictions coming through as you've seen in some other banking systems. So, is that a big enough difference? I don't know if I've missed any other.
I think that's good. Yeah, it's possible, but it's not our central scenario at this stage. But certainly that's one of the reasons we talk about these risks, that housing markets can change, and why we were worried that when price growth is too rapid, you can fall off the cliff and come down. Yeah. So we're really pleased to have seen a moderation, and we want that moderation to be prolonged, to carry on for some time. It could go faster down, or it could...
And I just want to remind the audience here, we're not here in charge of 1 to 3% house price inflation, and we're not trying to target house price inflation. We're just saying that when it comes to financial system and soundness, is it the banking sector that's going to be really upset through it, or is it going to be households if these types of things happen? And so we're talking very openly. The banking sector is well capitalised. They will be able to weather through many economic circumstances. Our household sector's in the same position. Each household has to ask themselves hard about that.
And if that scenario were to occur here, I might have just answered it, but you're confident that the banks and households could weather that?
I'm confident banks would weather some pretty extreme house price shifts. We do a lot of modelling through that side. The stuff that really knocks bank balance sheets around, which is why we want high capital, is cash flow. Are the people still employed? Because the house can always be on-sold, even if that's not the same householder in there.
Oh, that's okay. There you go.
Thank you. The Reserve Bank and Financial Markets Authority want banks to invest more in systems to improve conduct and culture. Could there be an argument that some of these issues could be taken care of if capital requirements were beefed right up, that actually having really strong capital takes care of conduct and culture issues?
In part, but in kind of a perverse way. One, it just means if you've got more skin in the game, you may take more notice in what you're doing. That is quite a sobering moment, that if, wow, I've got a lot at risk here, I better make sure that what my company is doing for me as a shareholder is actually sustainable and sensible in the long run. But that's about as far as it goes. The rest of the capital is about absorbing unanticipated losses. So you can still have high capital and very poor behaviour. It just means that the capital is going to get used if the bank is in real trouble. So you need capital, absolutely. That kind of wakes you up in the morning and gets you thinking hard, but you also need far better frameworks for thinking about the word outcomes as opposed to immediate satisfaction, that longer horizon. Sorry, Matthew?
Yeah, I'm just interested, when the LVRs were put on in 2013, I think, the bank estimated that they were amounted to about a quarter or a half point increase in the OCR. And I'm just wondering how you see that working in reverse. I mean, do you see the loosening as tantamount to a monetary easing, and does it have any impact on your outlook for the OCR at all?
Well, what we've said is this is a small relaxation. It's a very cautious easing. We think it's still binding. As I indicated earlier, we do think that ultimately it will allow a little bit more lending, and we'll have a little bit more demand impact as a result of that. But this is at the margin. I mean, this is the driver for this, and is trying to get the LVRs to do their job of leaning against amplified risks when they occur. And when those risks abate, we can ease them off a bit. Yes, there's always a little bit of implication for the demand conditions in the economy, but it's not driven by a monetary policy objective. It's driven by saying that we want to use these tools, we'll tighten them if risks rise, and we'll loosen them if risks decline.
These changes are coming into effect in January, a month before the tax working group is due to report back. And there are murmurings, obviously, about some sort of gain on tax on a capital gain. How do you see these intersecting with what you might be anticipating from that?
Yeah, I mean, well, these will only ever be altered according to lending conditions at the time. Lending conditions will be a function of many things, It'll be a function of demand, household ability to pay, and whatever, and the tax environment, whatever that is. So again, you know, the LVRs are in place now and forever. Just what level they're set at is going to be a function of all of that complexity around what is facing this industry. We spoke about quite a few different bits and pieces of uncertainty sitting out there at the moment for the housing sector. We've had the criteria for the quality of a house that can actually be rented, bright line tests around tax. You know, these are already being factored in. And sorry,
Foreign borrower.
Foreign
investor.
Yeah. Foreign investors. You know, these are all quite big issues that are weighing on the housing market's future. And so that's in the hands of people who want to step up and borrow.
Just on the capital review, what's your view on the use of internal models by the big banks, and whether either you move back to a simpler, more prescriptive model where the Reserve Bank sets the capital requirements, or whether that internal model's advantage that some see be extended to the likes of Kiwibank?
Yeah, again, good questions, Bernard, and I am looking forward to be able to talk, you know, well, we all are, not too dissimilar to the CBL challenge we had, being able to talk with the information on the table coming up in mid-December. I would just say at a generic level, as a simple regulator, simple tools and really clear capital is ideal, and then convince me why we need to be moving past that, and convince me why there should be such a gap the more and more advanced and complex the tools become. And then show me how those tools are actually being maintained. And so, you know, we're thinking very, very hard around what is the real quality of these internal tools? How are they truly being maintained? You've seen past examples. Jenny was holding us to task around one bank a while back around, you know, are they as sophisticated as they say? Are they actually being used? And is the gap in some of the capital holdings justified? Do we need to have some floor on, you know, difference between these? So we'll be able to outline all of these issues in December, mid-December.
So could the capital review involve a ditching of the internal model system?
Oh, let me be explicit. We've indicated already in the risk-weighted assets paper that we expect to retain IRB models, modelling, but we will floor it. We expect to constrain it.
Put a floor on it, not floor it.
Sorry, yeah. To constrain the extent to which it can deviate from the standardised models, if you like. So, yeah, we think that the use of it has become excessive relative to the actual risk differentiation. And yeah, the details of that will be in the paper that's forthcoming.
Over time, the proportion of bank lending to housing and agriculture has been slowly increasing, and the proportion to business lending has been going down. Is there any reason to be concerned? I mean, it's a bit of a perennial problem about New Zealand businesses needing capital.
Yeah, I think a big part of it is purely demand-driven. You know, New Zealand corporate balance sheets have been, in general, I know we'll bring out the specifics, so the ones that make the newspapers, but in general, corporate balance sheets have been in good stead. You know, you've had a period of strong profitability, good demand, and so I think banks have probably been struggling to lend what they would love to into the corporate sector. Meanwhile, housing's been quite the opposite. The capital constraining businesses in New Zealand is equity, not debt.
Just one final one from me. I discovered a particularly exciting chart, page 33, and wondered why New Zealand's life insurance commissions seem to be almost double the rest of the world's, at 20%, and whether this is something you're looking at or think is a good idea.
It's an exciting chart, and we put it in there specifically because sunlight is a wonderful hygienic sanitation method, and yes, there are real questions as to why is that so high relative to the rest of the world, and why is coverage so low. And this is what we've been talking about. Again, we can't micromanage this industry, but it has some real significant issues that need to be aired and talked about.
Should the insurance industry brace itself for slightly not such a great report back from you on the conduct and culture review that you're doing versus what came back on the banks?
Yes, and we've been saying that in a sense for quite some time, in the sense that banks have, they're large institutions, well capitalised, and have been far more practiced at having to answer these questions given the history of banking conduct inquiries. The insurance sector is smaller, far more heterogeneous across the different types of insurance, and there are a lot more principal-agent relationships going on. And I would say as well, the concept of capital can be far more complex. You know, when capital is some kind of PV of future revenue, well, you know, let's try and work out what that really is. So yeah, there are a lot of issues, and some of these have already been put on the table very clearly by the Financial Markets Authority around some of the sales practices and incentive structures. So we're working our way through all of this. They would be foolish to be surprised. They should be well aware. Thank you very much, everyone, for your questions. Go out there and be stable and sound.